Hi, welcome back to the continuing lecture in simple interest and simple discount. This is Dr. Jeff Hong, and uh, this is the second video in simple discount. And in our last video, we discussed what a promissory note is, and actually, promissory note, to simply sum it up, promissory note is a deferred payment from the buyer to the seller, and usually, the difference between the promissory note and the check. Of course, check is almost instantaneous. I mean, even if it is even if it is deferred, it's not, it doesn't take more than a week for the check to clear. The large amount of checks generally take like $500,000. The banks generally take time to clear the check, but the reason is not because most of the times it's because they want to use that money, right? They want to put it into some investment opportunity. So it's not easy to release the funds, that that quickly. But anyway, promissory notes are recorded in the balance sheet, right? As from the seller's perspective, right? Because seller receives the promissory note, and it is recorded in the current asset side, and it is like accounts receivable. It is considered a part of accounts receivable, and from the buyer's side, or the issuer, right? The issuer of the promissory note, right? From the standpoint of the issuer of the promissory note, that's part of it's notes payable, right? Basically, so it's part of the accounts payable. Okay. So and I said also that the promissory note has carries interest rate, and has maturity, usually anywhere between 30 to 60 days. I mean, more than 60 days, maturity longer than 60 days are not very popular. Now, interesting thing is that the promissory notes, if the maturity on the promissory note is 60 days, in principle, if you're holding on to the promissory note for 60 days, right, then you will receive the interest and the principal. For example, it's like this. So you will receive, if Dell purchased $100,000 worth of parts and components from the manufacturer, and issued the 60-day promissory notes at 10% interest rate. So obviously, the principal amount is 100K. And then with the interest, 10% interest, then you think, oh, so it's, 110,000. No, we can assume, for simplicity, we can think, we can assume that way, but think about it. All the interest rates are annual, so 10K would be the interest if you hold it for 1 year. But the maturity on the promissory note is only 60 days, right? That R is APR, right? So to be exact, we already know time, 60 days. Then what's the face value of the promissory maturity value? We call that maturity value now because at maturity, that's the same thing as future value. What's the maturity value? Maturity value will be then, we all know, principal times R times T, and this T is in years, right? So the maturity value will have to be 10K times 0.1. I'm sorry. Where is the eraser? 10K, that's not minus. This is not easy to. Okay. Drawing with the mouse is not that easy, right? 10K times 1 plus 0.1 times, right? Uh, 60 over 360, which will be 1 over 6, right? Anyway, 60 over 360, right? Okay, that's the maturity value if you hold on to it now until maturity. But let's just, for simplicity's sake, let's assume this is just, 110K. Now, if everything goes well and the recipient of the promissory note or the seller, right, has no cash flow problem, if they have no cash flow problem, there's no problem. They can hold it until maturity, and at maturity, they present it to the issuer, and they will collect 110K. But as I said, most small suppliers, right? I mean, for Dell, keyboard manufacturer is a supplier of parts and components, and it is also called vendor, right? So most vendors are small businesses, smaller, relatively smaller companies, and they are constantly fraught with, they're constantly suffering from cash flow shortage, right? So they don't have the luxury of waiting until maturity. They don't have the luxury of holding on to it until maturity. So what are they? And so if they are hit by some, cash flow problem, what are they going to do? What are they supposed to do? Now, this is where, promissory note works, comes into play. The promissory note is part of the liquid assets or financial assets. In other words, it's a commercial paper that can be negotiated, negotiable with the bank, right? In other words, they can sell it to the bank, okay? Now, promissory notes, think about it. Cash is already cash, right? Cash equivalents are short-term securities that are easily converted into cash. It's called, liquid assets, and marketable securities are long-term bonds, short-term bonds, and stocks. But then, short-term bonds are generally, considered, it can be considered as cash equivalents because their values the prices do not fluctuate that much. In that sense, long-term bonds, do not fluctuate in value as much as the stocks. Stocks, fluctuate in value a lot. So basically, cash equivalents are short-term assets that are easily liquidated or easily converted into cash. So if they are and those assets are called current assets. Current assets are basically assets that are very liquid. And promissory notes are part of the also liquid assets. So what does that mean? Promissory notes can be easily converted into cash. In other words, you don't have to wait until maturity. You don't have to present it to the issuer. You can take it to the bank and negotiate the price, right? They are negotiable. So in our example, if the maturity value, this is not clearly, $10K. It's not clearly 11K, right? But let's just assume that this is just for the simplicities, right? Say, let's just say 11K, just for the simplicity. Now, if you hold on to it to maturity, then you will get 11K, but you can't hold it until maturity, so you take it to the bank and sell it, right? And the bank won't pay them 11K, clearly, right? Think about it. No bank, so it has maturity of 60 days. Technically, they can sell it to the bank already on day one, right? Now, think about it. If they sell it on day one, will the bank give them 11K? Suppose bank paid 11K, bank gave 11K to this company, and bank is then, what's the bank to do? It's going to hold it until maturity and present it to the issuer, and they will collect 11K, right? But then bank is doing, I mean, if the bank gave out 11K to the company that brought the promissory note to the bank, if they gave out 11K, then the bank is doing this for nothing, isn't that right? Bank has to make something out of this. You understand? If seller sold, and it's called actually, factoring, if the seller factored it on day one, actually seller didn't take any risk to deserve that interest. You understand? If the seller held it for the full maturity, and then they deserve, right, the interest. But if the seller sold it to the bank on day one, they didn't take any risk. They are not taking, from the minute they are selling it to the bank, they are not taking any risk, right? And it's the bank that's going to take the risk, right? The seller isn't waiting at all, not taking any risk, but the burden of risk and waiting falls all upon the bank. Okay, makes sense? So a bank deserves the full interest. The seller deserves no interest, right? So this process, if you think about it, what risk are we talking about? Think about it. The risk of the issuer defaulting, right? So if you think about it, promissory note is like a short-term loan, right? Short-term loan for 60 days, given by whom? Given by the seller to the buyer, right? In other words, when seller agreed to accept the promissory note, it's like, giving a 60-day loan to the buyer or the issuer of the promissory note. So in other words, the issuer of the promissory note is the borrower, right? It's like, they borrowed for 60 days, the money that they would pay back in 60 days, right? So think about it. When you are lending, so it's like, this seller has passively become a lender. So when you are lending money, what is your biggest concern? Your biggest concern is whether you'll get your money back, right? But also, you can rephrase it as whether the buyer or the issuer of the promissory note, whether the borrower will default on their loan, right? Makes sense? That is the biggest risk you are facing, right? So, once this company sells the promissory note to the bank, the risk is all transferred, right, to the bank. Make sense? So the bank won't do this for free. The bank will discount. They will need to take their cut. So for doing this service, for taking the risk, instead of for the bank will have to take their cut for, they will need to get compensated for taking this risk for this seller. Make sense? So logically, it would make sense that the on day one, if they brought it on day one, right, to the bank, then the bank pays only the principal and keep, at maturity, they present it to the issuer and they receive 11K, and then they keep the entire, they make the entire interest. They keep it to themselves. Okay, makes sense? That process is called discounting. I mean, because the maturity value was 11K, but they discounted to 10K and just give 10K to the seller. Now, this process It's called a simple discount, right? And interesting thing is, um, they in this example they just simply discounted it by the interest, right? But actually, so you might think, oh, so they took that 10%. Yes, but actually they may discount it by more than 10%. The bank may discount it by more than 10%. For example, they can discount it by 15%. If they discount it by 15%, right, and uh, uh, it will be, roughly like 85% of this that uh, the company will be getting, right? But again, think about it. Bank is not a philanthropy. Bank is not a charity or philanthropy. They are Bank is in a very selfish, business, right? Any business, I mean, all the businesses are operating for their own self-interest, right? Um, so the bank will try to apply higher discount rate, right? Higher discount rate, um, as high as possible, right? As high discount rate as possible, right? To skew the skew that split more to their favor. You understand? So, and this process is, uh, called, factoring. I'm going to get to that term later. Now, so there are two types of promissory notes. First, non-interest bearing and interest bearing. Of course, we've been using interest bearing promissory note examples so far because that is normal. But sometimes some promissory notes are non-interest bearing, meaning they're not paying any interest. And is it possible? I mean, um, yes, it's possible. Think of it this way. So once again, it has a lot to do with the balance of power, or the power dynamics between the seller and the buyer. Now, if the buyer is a large company that has uh, strong influence in the industry, right? Usually, the strong companies, um, exercise a lot of, influence in the industry. Um, so, in a way, they flex muscles, and smaller suppliers, they depend, they are so dependent, highly dependent on the orders from these large companies. So these large companies they may not, you might think, it's nasty, they are so, if, um, but, these large companies can flex muscle and they say, well, we'll pay with promissory note, but, we can't pay interest. Um, we'll pay with, 30-day promissory note, but we can't pay any interest. Now, what would you say if you're a small vendor or supplier? Will you say, "Oh no, that's unethical," or that's are you going to that's totally unethical, that's immoral? Are you going to say that to your big buyer and big spender, and um, just uh, what should I say? Irk the big spender, the big buyer, right? You don't want to. You want to rob your big buyer in the wrong way. You, uh, you don't want to. upset a big customer, right? Whether you like it or not, you'll have to take that. It's better than not selling anything, because if you say no, we won't take that. Uh, you know, uh, then then what's going to happen? What are they going to do? Well, then they will say simply, well, I'm sorry, but this is our payment terms. If you're not okay with that, we'll have to reconsider our business with you. There are plenty of competition. And they know there's plenty of competition in this industry. The suppliers there. They will always take their business to somewhere else. So you're not in a position to say no. So you take it, right? So that's a non-interest bearing promissory note. And besides, it's like a very short term, like under 30 days. So if that's the case, okay, now and when you receive this non-interest bearing promissory note, then what is that? The maturity value is exactly the same thing as principal, if that's the case. Isn't that right? And then when you take it to the bank will apply. So suppose you are holding on to it for the first 10 days. This is a 30-day promissory note, right? Non-interest paying 30-day promissory note. You were holding on to it for the first 10 days. Originally, you had no problem with cash flow, but suddenly on day 11, your company suddenly ran into a cash flow problem. You're tight, very, you're out of any cash flow. So what do? Then you'll take it on day 11 and you sell it, you take it to the bank and sell it to the bank. Or in other words, it's also called you factor. You factor it on day 11, right? And then the bank will, what does that mean? Then the bank will, if the bank buys it from you, they are taking over the risk, right? And then they will, hold it for 20 days and they will present it to the buyer. So they will have to discount it. So they will discount it for the period that they are holding it. In other words, they will discount it for 20 days because for first 10 days, it's already gone, right? First 10 days, you are holding on to it. So it's already gone. And then what's left is 20 days. So they will discount it for 20 days, right? Makes sense? So that means, they will use, it's like, so if they use 10% discount rate, what is their cut? In other words, if they use 10% discount rate, what they will do is they will discount it by the interest they take is 10% of 10K. So, but it's for 60 days. So, I mean, for 20 days. So actually, to calculate it, it's going to look like so what I'm doing here is how much interest are they taking, right? Or how much it's not, I'm just calling it interest for now, but it's not really, it's called bank discount. So the calculation is simple. You will, you will multiply 10K by, sorry, that's not 10K. 10K times 10% times 20 over 360. Okay, makes sense. Now, this is called actually a bank discount. So, but although this is, the exact number will be, calculated this way, but let's just say this is, 1K. Okay, just to make it simple. Okay, let's just say this is, 1,000. Then, what is exactly, what amount are they paying you? Then they will be paying you, right, 9K. This is what you get, right? They will keep 1K. In other words, the promissory note with the face maturity value of 10K, maturity value is exactly the principal in this case because there's no interest paid, right? Interest on the promissory note. So you take it to the bank, and bank used 10% discount rate. They are discounting it by 10%. And although it's for 20 days, you just ignore it. Suppose just so they are discounting it by 10%, which is 1K. Then what are you getting? They will give you 9K. Make sense? But for you, you might say, oh, that is, you might say, that's unfair. You might say, that's unfair. No, but it's better than nothing. I mean, if you don't, remember, you're in a cash flow problem, right? You're in a very dire cash flow situation. And if you don't have any cash, then you will go bankrupt, right? You have a lot of payments to make, and these payments must be made in cash, not anymore in promissory notes. Think about it. You have, because of these accounts payable and notes payable, you have a lot of accounts payable, a lot of notes payable. So you need cash of, at least this amount, equal to this amount, right? But you don't have cash for this, then just because of that, basically you are defaulting. You're defaulting on your payment obligations. And if this piles up, that's bankruptcy, right? So the idea is, the bank discount. This is called bank discount. I'm going to have to what you receive from the bank is called proceeds, right? And the symbol for that is D. Okay, so that means it's the discounted amount from the maturity value, right? Discounted amount that you receive from the maturity value. And the bank is going to hold it for 20 days, and they present it to the issuer, and they will receive 1K. Okay, so this is called bank discount. In other words, that's the, you can think of it this way. That's the upfront interest that the bank takes, right? That's the upfront interest that the bank takes from. So this is the bank discount. Okay, and then And the 9K that you taking from this bank is called proceeds, right? The correct, terminology is proceeds, and the symbol for that is D. Okay, so never mind, proceeds is P, D, so you cannot make connection between, P and D. Never mind. Um, D stands for, obviously, discounted amount, right? Discounted amount of the promissory note. But that's what proceeds from this negotiation with the bank, this factoring with the bank. Okay, so that's the concept of simple discount. But in this example, this was very basic example, and um, the interest-bearing notes, right? We just talked about non-interest-bearing notes, but we will need to talk about the interest-bearing, discounting the interest-bearing notes too. Okay, so that will be in our next lecture. Okay, all righty. So thank you for watching. I will see you guys in the next video.